My name is Michael Latrue. I'm a dealing representative and advisor with Parvis Investments. Joining me with is one of my colleagues, Mr. Robert Blake, also an advisor. And we have the privilege today of having the kind folks from Kin Capital joining us today to explain to us a little bit more about the fund that we're bringing to market. Lots of great opportunities out there, and this is one of them you're likely not going to want to miss. So a little bit about Parvis. We're an easy to use platform in the digital space. We give people access to asset classes and investment opportunities that you wouldn't normally find through your regular channel. So you wouldn't find this on within any of the stock markets, Wealthsimple or at the bank as an example. And then everything through Parvis, we're able to get you all the information that you need in order to make a wise decision about how to invest your dollars moving forward. So important notice, this content is not intended to provide and should not be relied for on investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or a solicitation of an offer to buy any securities. This is probably the most expensive slide in the deck. However, when you do have questions, we are here to help guide you and answer those questions for you, and then take you on to that next step, which is where the magic happens. Oh, sorry. All right. So Kin Capital Income Fund. So what's in it for investors? It is a real estate investment trust, growing and ongoing, managed by an incredible team of people, which they will be introducing themselves in about 15 seconds. But overall, you're looking at acquiring assets across Canada. Minimum investment currently is set at just over $1,000, so a great opportunity to get in at a lower end and then just add money to it as you go. However, we do typically recommend you invest a little bit more just so you can see the great results faster. It is an opportunistic opportunity with projected returns annualized of between 16 and 18%. And you're looking at about a 4 to 5 year term horizon. So you're not in it for 35 years like some development projects that I've worked with in the past. So with that, I will pass it off to Mr. Jacob and David, and they will tell us a little bit more about what they're doing and why, and how in the end it's going to benefit everyone here as investors. So Jacob, David, please take it away.
Thanks a lot, Michael, and thank you, Rob, and welcome to everybody. I can see you're all up in the screen there, so thank you for taking the time this evening. I think it's important before we talk about the fund itself for you to understand a little bit about the people behind it and the experience and expertise they have. All of management is extremely experienced with a long track record in multifamily. So tonight we'll be talking about multifamily. You may know it as apartments. Me, for myself, I was a partner at Osler, Hoskin and Harcourt, and then joined a firm called Starlight Investments, which ended up being the largest owner-operator of apartments in Canada, with over $30 billion of those apartments, about 80,000 units. So quite a large portfolio, and that was built over 12 years. I've decided to join my partner, Jacob, and recreate the apartment magic again in the value add space with a focus on Montreal. So I'll let Jacob introduce himself to you.
Yes, first of all, I would like to add that we need to lower the expectation to surprise people with mediocre results. So we are basically focused right now on Montreal because this is where we found the dislocation. My background, I started Kin about 5 years ago as a real estate investment bank, and what it actually means is that we would effectively broker and advise on equity and debt and everything in between. And we've done about $2 billion of those in a span of 2 years, and then we moved to the investment side. At the essence of what we've done, we were matching the capital with the opportunity and the sponsor or the manager to execute the strategy. And we were basically in 23 looking for an investment strategy that would fit the risk-adjusted returns of the time where the interest rate were at that point of time elevated. And we saw some headwinds in certain asset classes like development that some of you may be aware of or experienced right now as investors. We looked at the apartment space and we looked at other asset classes, and we felt the combination between The availability of capital with the government-backed financing in the form of CMHC, combined with the headwinds of rental growth in Montreal, given the affordability, call it price point of the apartments, is a great combination to start deploying capital in Montreal. And because our background is coming from the institutional world, we've basically created an institutional size or institutional scale platform, even though we just started. So by the end of this quarter, we'll probably notch off around 200 million of assets. Our first acquisition happened in July of 25. So relatively speaking, in 6 month time, we're at about 200 million of AUM will be. And going forward in 26, the goal is to grow these to about, call it $1 billion of AUM during 26 and raise about, give or take 100 to 150 million of equity.
So what you see on this page is really best in class providers in the real estate space, and particularly in the multifamily space. You see lenders who you can all recognize, CBRE, CMLS. You see our advisors from tax to audit, and all of those things. Every year, so you understand, we provide audited financial statements at year end, and we give quarterly, what is equivalent to a public MD&A, but it's really a presentation that's digestible, that tells you the comings and goings of the fund, the progress we've made, so you're always in tune. It's also important to note that we're very accessible. I'm used to a lot of what we would call retail, and we are very responsive. So as Michael and Rob can attest, we make ourselves available. You can always call us. You can always email us. We're always happy to answer questions, and we're always happy to tell you what's coming next inside of Kin Income Fund. So maybe we'll just flip the slide. So overall, you have to understand apartments. You have to understand a few things that are happening beyond the financial piece. So as many of you are aware, over the last number of years, Canada has had a significant amount of immigration. You're also probably aware, as you drive through your neighborhoods, notwithstanding what you see in your downtown centers, whether it's downtown Toronto, Montreal, what have you, there's not a lot of construction happening. So Canada, to keep up with the housing, we'll call it shortage, which you read about every day in the newspaper, hasn't really addressed the situation. It's becoming more and more of a renter's market because housing has obviously become more unaffordable from the purchase perspective. And at the same time, we're not filling the hole that is happening with all of our immigration, notwithstanding it's slowed down. So at last count, CMHC thought there was something like 425,000 missing homes in Canada. I would argue it's higher, but regardless, there's a lot of missing homes. And of course, everybody needs somewhere to live. So that's the overall thesis. Our thesis is really to go to cities where we think housing is affordable, where we think housing is selling at a dislocated, less expensive price. Just like when you go to the store to buy goods, you don't go buy the most, you wait for the sale. It's time for the sale right now in Montreal on apartments. And we work in places where there is barriers to entry. So what does that mean? You won't see a lot of cranes in the neighborhoods we're in, which are what I would start off by saying they're submarkets of Montreal at the beginning. These are areas where there's not a lot of space left to build anything at all. There's often red tape, as you've heard about and read about. There's development charges. There's all sorts of municipal charges, which make building prohibitive. What that really does is it creates a supply-demand imbalance. And what a supply-demand imbalance as an owner creates is an ability to transform what would be older stock apartments into something a little bit newer, a little bit fresher, a little bit nicer. So what we're really talking about here in Canada, and we'll talk about Montreal, but really the whole country, is predominantly you're looking at apartments that were built between, say, 1950 and 1980, and then there is a flat stop in construction for the most part. You may see some very fancy buildings go up, but really that sort of where everybody lives and where most people live in this country stopped being built. So you have this pent-up demand without any new supply. And what that really has created is an opportunity. So, I mean, our thesis is really, really straightforward. We are buying at or near the bottom of the market. Now, there is no way to tell exactly, but we feel it because the pricing and what we call in real estate cap rates, but we're seeing some cap rates that are very exciting and very digestible to a buyer and leave us lots of room for profit as we do our plan and then sell the building. So that's number one. Two, we see debt, as you know, if you have a mortgage, interest rates are coming down. So as interest rates come down, the cost of borrowing comes down. So when you're buying cheaper buildings that are at or near the bottom of their pricing with low interest rates, which are even subsidized further by our friend, the government of Canada, through CMHC, giving us long amortization periods and low interest rates, you start to get a disconnect. And the disconnect is the opportunity. Montreal, a very affordable city, believe it or not. You have 4.5 million people, and rents on the rent roll are quite low. And when I say quite low, we have lots of rent on rent rolls that we own buildings on that are in the under $1,000 range for 1 and 2 bedrooms, which to me tells me that there is a lot of room left. If I told you you could rent a 1 bedroom in a major city for $800, you would probably tell me, wow, that's pretty amazing. Where do I get that? So what we're basically doing, just to tell you, what we're basically doing is we're finding spreads between the price of buying something and low interest rates, and we're using that difference to create value for our investors. And by the way, we're huge investors too. So everything we tell you as an investor pertains to us as well. We have quite a significant amount of the fund, over 10%, and we intend to stay there. So we're co-investing with you as we do this, and we believe it. Now, if you look at the bottom of the screen, what you see is, and we'll go right to the right side of each of the graphs, you see, wow, Montreal continues to go up. And that is actually very good for buying apartments in Montreal. But at the same time, it shows stability in the market of Montreal. And I would argue the submarkets are even better than what you see. Mike, do you want to just head back? Okay. If you also go on the other side to the vacancy rate, what you see is Montreal's vacancy rate is lower than the rest of the country. So you have this supply-demand issue happening where there is far more demand than supply. You have rent going up in Montreal more than any other place, and you feel this like groundswell. So if you look at the revenue of a building, it should be going up. And if you look at the vacancy, it should be stable, if not going down. And so when buildings are stabilized in our portfolio, we expect them to perform at about 3% vacancy. You may say, why 3%? Why not 1% or 0%? And part of the strategy, just so you understand, is we want to drive value by increasing rents. And the way you do that is when a unit becomes vacant, you take the unit offline and you renovate it. And what we're finding in the renovations of these suites is because, and we'll show you on the next slide, but what we're doing is renovating it to a standard where you would want to live there. That's a new kitchen, new cabinetry, stainless steel appliances, a new bathroom, whether it's subway tile, new bathtub, new sink, large mirror. So really upgrading it. New flooring in the unit, so that would be like a vinyl plank flooring of today's, I'm not a designer, but it would be today's en vogue color, probably a light wood color today. Some pot lights in the ceiling, and a nice coat of paint, and some baseboards, and there you have a new unit. Now, we budget in our buildings for probably around $20,000 per unit, but because of our structure, we're actually turning them for far less, which is a benefit to everybody. Why do we do it? That's the question. And the answer is really simple. If we start off with a unit, a 1 bedroom at say $800, and we spend say $6,000 to renovate it to what I just told you, some units require more, some units require less. What we're finding is the rent is almost doubling. So when you take a double rent and your return on cost, so just take what we spent divided by $800 more a month, do it for 12 months, and you actually are you've outperformed what you could possibly imagine outperforming to renovate that unit. When you do other things in the common areas, let's just talk about the basics. Paint the walls, improve the lighting, change the carpeting or flooring if necessary, put security cameras, put a better intercom in. These are things that attract tenants to pay that extra amount, those extra dollars. They like it. We fix laundry rooms if the suite doesn't have laundry in suite, which many older buildings don't. All these things add up to one bigger thing. And then we create more value for the owners of the buildings, charging for parking, putting cellular towers on the roofs, charging more for laundry. These are the types of ancillary services we add, which create revenue for the building, or what they call in the industry NOI, net operating income. When you take all of that with the higher rent, what you've done is effectively increase the value substantially, and somebody else will come along and pay more for the building. So we do enough renovation for the person to see the dream, see the vision, see the increases, see the professionally managed building. And how we do that also is we partner with we have an operating partner in Montreal who's a professional manager who also invests in every deal, also sits on the mortgage. So just so you understand, you are shoulder to shoulder with the person who literally is renting your suites. And that is a unique structure which truly is working. So
yes, we can kind of see it in the next slide.
Yeah, sure.
When you see about the structure of how we've done. So like there's two major pieces that, David and I, after years of experiencing and structuring a lot of deals and a lot of call it funds and private equity funds in the business, have kind of came to realize. In the close-ended fund, the problem is that somebody promises you your money back for sure in 5 years. And if the market doesn't really agree with that statement, because it's a weaker market or something happened that you can't dispose the asset in 5 years, it will come back to you as an investor and say, Mr. Investor, we're sorry, we need 2 more years or 3 more years, and typically your 5 years are going to go before you know it to an 8. That's a big problem because you were promised something and you were not delivered. The other problem is if you go to the open-ended structure, all the open-ended structure are basically designed to basically grow forever and ever and not create a real exit. And the misalignment in the open-ended structure is very apparent because your fees you earn as a manager and your carried interest, which is basically the performance fee that you earn as a manager, are based on values that are being effectively paid by the manager to assess. So effectively, me as the manager go to an appraiser and say, appraiser, I'm engaging with you to assess the value of my portfolio. They come back and give me a number, and based on that number, I charge you, investor, more fees, and I charge you my performance fee on an annual basis. And I show you a statement that says, oh, Mr. Investor, your investment grew by 15%. This is great. But the reality is there's a potential misalignment between the values that the appraiser gave you to the market, and you can't really enjoy the benefit of that as an investor because the cash flow from the asset in most of these structures have actually come down because more fees were charged to you as an investor. So your cash flow is going down, your value is supposedly going up, but you're paying for the manager for it, even though you haven't crystallized it. And when everybody try to exit, the manager says you can't leave because the assets are not liquid. So
we did the opposite.
Exactly. We basically said our approach is to create the value and to sell. So therefore, our fees are not tied to the valuation. So the valuations could go up, which is great, but until we're not selling the building, financing it, recapping it with another investor, we're not benefiting from the performance fees, and our asset management fees are 0% in the first 2 years and then are fixed to the purchase price way below market at 0.2% for purchase. We have no benefit of holding it longer. We are here to create the value for our investors and for ourselves as a very big investor and sell. Simple as that. So we've created that structure from a fund perspective. The other twist we've added is, and that's a problem that David maybe can speak to when he was managing as part of Starlight, 80,000 units, is the challenge of operating an asset that is effectively a business to customers business. You have hundreds and thousands of different customers that are rolling on a monthly basis in many cases, and you need to serve them. It's a nickel and dime business that is very much driven by the quality of the operator that you have. The main challenge is that most of these managers are not either vertically integrated, meaning they have all the way from the property management function, which is a very challenging business to run, all the way to the asset management, which is basically the people that makes the decisions on how to run the property, from, in most cases, Toronto, but they could own many, many assets across the country. And what ended up being is that the person that is responsible for these assets is rarely visiting those assets. And the people on the ground are not perfectly communicating with the people here in Toronto. So in many cases, when we buy properties from people that are not from Montreal, we ended up figuring out there are mistakes in their own rent roll. They don't know which unit is leased and which is not, as bad as it sounds. And what we've done is we've found a local operating partner that, as David alluded to, invest with us, as you can see in the org
right
chart.
on the org chart where it says operator, they come right into the properties.
Correct. And every deal they approve with us, every deal they underwrite with us, every deal they're responsible to execute the business plan with us. And what it creates is alignment. We are a large investor, they're a large investor. They don't make any benefit from running the properties for the sake of running the properties. We're here to create the value, increase the benefit to all of us from a cash flow standpoint and equity growth, and sell the property. Simple as that.
The other thing about the structure, just as you can see at the bottom, which is quite important to point out, is designed as plan eligible. So you can put your RSP money in, your TFSA, your RESP, and that's because it's a private mutual fund trust. So that is quite important for many of you as you make your allocations in the next short period of time. And that, of course, is part of why we designed it the way we designed it as well. But again, we've created meaningful alignment between us and our investors. We're not interested in holding the properties beyond when we should. We're interested in exiting the properties. We are lean and we are teamed up with people on the ground. It's also worth noting, as Michael and Rob can attest, we actually come to Montreal all the time. We're there every week or 2 weeks. We visit our properties. We talk to our operator about how it's working, what is working, how it's working. We're getting daily updates on leasing volume, opportunities. We see the rent rolls. We see the growth. We're uber focused on all of that because we believe your money is worth protecting and our money is worth protecting, and we're here to make it grow. That's really the whole thing. So next slide.
I think that's it.
Well, I guess we're at the thank you slide. So
Perfect, guys.
there you go. If you have any questions, I guess Michael's saying you can type them. If you want to speak to us, we do have a website, kincapital.ca. You can go there. You'll find us. We're on LinkedIn. You can call us. You can get our numbers from Rob or Michael. No problem. We're not hiding behind a veil. We're here for you and to answer your questions, no matter what they are. And again, we're quite proud of this product. We think it's meeting a opportunity in the market. We think this is the moment to do it, and we are heavily invested in it ourselves with you, shoulder to shoulder, meaningfully invested, because we believe in what we're doing.
Excellent. Well,
Okay.
Thank you both. Typically, Robert has good questions because sometimes investors, either they're shy to ask or they're not sure what to ask at times until later. So Robert's pretty good.
There's a question from Steve.
Oh, here we go.
Let me address it. So we want to be kind of very clear. Exactly. We want to be very clear about how we operate and how we structure. Some other REITs and other structures, you would get a guaranteed quarterly distribution, and you would get a guaranteed ability to exit and liquidate. We want to be very clear, as part of our experience, is that the most important thing about this whole exercise is matching the right capital to the right opportunity. This is an illiquid asset that would generate liquidity when we refi or sell the assets. So there is redemption ability like any other mutual fund trust, but as you've seen out in the market,
it's very limited, very limited.
It's limited, and it's practically speaking, as you can see across the market, all the mutual fund trust private REITs are basically gating investors to prevent them from doing. So we want to be very transparent and open to the fact that this is an illiquid investment. We're coming in, we're creating the value. When we sell the building, there's liquidity. Until then, there's no real liquidity.
The other truth of it is that because we're doing the value add, the construction, a lot of the equity, the income that's generated goes to do that construction. When a building stabilizes, in other words, when there's above 95% rented the units, it starts to generate positive cash flow. At that point, there's a possibility of a quarterly distribution. But as the fund continues to expand, in the short term, there will not be a quarterly distribution. But Steve, to really answer your point, we're like you, we're investors. We look forward to the quarterly distribution as well, and it will be made in a prudent and reasonable time frame to ensure the health and the stability of the fund.
100%, and I will just add that we're very much a total return focus.
Yes.
So we would deploy the capital or distribute it whether it's best suited. So if we have an opportunity to invest more dollars in the property, that based on the multiple that the potential buyers would pay us, we would take that dollar and reinvest it in the property in order to increase the dollar value amount of the property of the sale, and be patient and not take our 8 or 10% cash on cash, and we'll take a little bit less in order to generate more value and make more money at the back end. As soon as David alluded to, we'll stabilize the property and it would be cash flowing significantly. We will keep our buffers in place to make sure we have an ability to answer any surprises the property may need in terms of funding, but we will start distributing. I think one of the most important things to notice about this time relative to other times in history is that in history, you used to compensate with total return, effectively like with equity value growth at the back end, and limited to no cash flow during the whole period because it was so competitive with pension funds, you couldn't really compete on getting straightforward cash flow from assets. I think in this time around, with the government-backed financing and the prices of the assets, we're able to actually get both. And I can even share with you a case study that we've done outside of the REIT as our first investment in Montreal that we've done about a year and a half ago. We've projected a very low cash-on-cash return in year one that would be somewhere in the 3.5%. We finished all the value add and CapEx work within the first year. So we basically stabilized the building. We've distributed. We had a special distribution of 6.5% cash-on-cash in year one, plus a meaningful buffer that sits in our account for surprises or anything that may need from the property. And we're basically under contract today to sell that property for the price we projected to sell it in year 5, meaning our money, and we're the largest investor in our cap stack. We're going to double our equity in a span of time that would be, call it in and around a year and 3/4, call it sub 2 years. Not because we're geniuses, because we've actually did the work. We've increased the rents on approximately 30% of the building, that increased the NOI by approximately 15 to 20% because we've also invested in energy efficiency to reduce the cost of operating the building. Mm-hmm. And we basically finished the business plan in about a year's time. And therefore, we got an unsolicited offer to sell it at the value we projected we'll get in year 5 because we projected to get about 20 to 25% increase in NOI during the 5 years. So we think, and by the way, we see the same patterns in the assets we bought within the REIT. We're way ahead of business plan, below cost, and that's really what we're seeing in the market.
So Steve, next question is, could you keep going after 5 years? And the short answer is, of course you could. There will be other opportunities always. This is not this program has moments. You have to pick the right markets. You have to pick the right time. Obviously, you ride with the trend. But yes, we'd be more than happy to have people stay on. But what we're trying to explain is that we will sell the buildings we have and potentially find others for those that wish to continue on at the right moment at the right price. But what we won't do is buy buildings that don't make sense for the program, because what we don't want to do is dilute your returns. So we will not be putting out money to just put out money. We will be putting out smart money. And if it's there when it's still there, absolutely, we'll be happy to talk to you and have you continue on the ride. But we're trying to make sure everybody sees the path to liquidity, although we can't guarantee exactly when that will be.
Yes, and I would just add that the way we structure the call it the performance fees and our asset management fees are basically geared towards actual results. So if we see a path to sell all the portfolio in year 3 and generate the same type of returns, we would do it in year 3. If year 5 is not the time for us and we need to wait patiently for another year, then we'll wait patiently for another year. We are using MLI Select CMHC mortgages, Steve. Sometimes we would basically finance it upfront with a CMHC MLI Select. In other cases, we would do a bridge to CMHC, basically taking a traditional loan, increase the NOI, and then put a CMHC financing on it. The advantage of Montreal is that we can, in all the deals that we're buying in Montreal at least, we're basically getting to 70 to 100 points of MLI Select today, because in almost every deal that we're buying, we would have an energy efficiency component that, as you know, would contribute 50 points to those who understand how the point system works in CMHC. And the other 50 points would either come from affordability, because most of Montreal is extremely affordable below the CMHC bar. If we don't find it there, we would typically go for accessibility in very select buildings. We would pick and choose the right building for that, and we would apply that in order to get those benefits of leverage.
For those that don't understand the MLI Select program, functionally the government is incentivizing owners to renovate and upgrade buildings by giving attractive interest rates with attractive amortization rates. So the more that you can do to improve the building, whether it's energy, whether it's retrofit, whether it's affordability, and as Jacob was saying, if the affordability is here and all the rents are here, you don't even get to the affordability number. Those are things the government is trying to do to improve the living standards of Canadians, and we're taking advantage of that program through CMHC.
What's really interesting, gentlemen, is is the best I know, the island of Montreal is an island. You can't expand the island, and I see your point being it's built out, it's very scarce. You're not in direct competition of buildings propping up next door and creating competition. So very interesting
Yes.
thesis.
I think a point I would make that is very interesting about Montreal compared to other markets, and we constantly look at Toronto, we constantly look at Vancouver, constantly look at Ottawa, which seems to have the same interesting fundamentals as Montreal, is that one, the affordability that we talked about is a meaningful thing, because that's really determined the path for growth of NOI over the, call it 5 or 7 or 10 years or 3 years. Like, you see the path for growth. The other one is because the vast majority of supply is basically old apartment buildings, and the rents across the market is very affordable. There is a high number of turnover relative to the major markets. So Toronto, for example, all the new supply that came into the market over the past 20 years were, practically speaking, condos or brand new apartment buildings that are situated in the core that are very unaffordable for most people. And therefore, if you lease, and the rents in Toronto have skyrocketed basically over the last 10, 15 years. And if you are now an apartment tenant in one of those older apartment buildings that have paid the rents of 10 years ago plus CPI increases of 2 or 3% a year, if you were to move to any other apartment in the city, you would approximately double your rent. And that becomes effectively an impossible mission for you as a tenant. And therefore, the tenants that have been in those apartment buildings in Toronto, even though people would tell you, oh, the gap to market is $1,000 a month. It is very true but the people are not moving and they cannot afford to move. So the $1,000 a month gap is going to stay there for a very, very long time. It's going to be very hard to realize that gain. That's why we're not playing in Toronto these days, because we see that the only people that are moving in and out of these apartments are the people that were leased 2 years ago at the peak of the market and are now finding a better deal outside. But the ones that leased 10 years ago are not moving. In Montreal, because everything is affordable, people are naturally moving. And we see a turnover rate of in and around 15 to 20% in the building that we're buying until we stabilize them. And then we start seeing a lower turnover as we like to
that drives the value add program. You need vacancy to do the work, and it's natural vacancy. So we are actually improving the lives of the people that move in after, and they're willing to pay for the units.
Correct. And it's a natural,
very natural.
The other interesting point in Quebec, which is the only place I know of, is the actual moving day of July 1st. And maybe people on the call don't realize this, but everybody moves on July 1st.
Well, one thing for sure in Canada, which I can tell you, is the apartment business, and really the housing in general, is seasonal. Nobody moves in the winter. I shouldn't say nobody, but like
few.
Very few, because as we all know in Canada, it's the winter. There's nothing more you need to say. So if somebody were to tell you this business is not seasonal, I would tell you that's not true. What I would tell you is we are having great success, notwithstanding this winter, and it's not been the most pleasant winter across most of this country, I would say that. But we are actually having significant leasing volumes in our buildings, notwithstanding this weather, which tells me that our product is affordable still, and we'll call it value. You're getting good value, which means you're paying what you like, what you think is fair for a newly renovated unit. And one last thing I'll leave everybody with. Always remember, the older buildings are bigger units. So if you're one of the price per foot people, which I kind of think of things in the aggregate as well, because everybody has a maximum limit, you get much more space for your money in the older buildings. So it's always something to think about. They're more family oriented because you're not in a very tight, compact space, and they're more livable. Our buildings are across from parks and in walking distance to, community strips and community parks and all kinds of playgrounds and schools. So these are where people actually live, and this is how Canadians are going to be living.
That's very, very good.
Okay.
All right.
Well, excellent. Well done, gentlemen. Thank you for the insight, the institutional insight. It can't be emphasized enough, the know-how that you're listening to here from these gentlemen. It's top notch. So
absolutely.
thank you.
Thank you for your time, everybody.
Thank you, everyone,
for taking the time this evening, guys. We're always available. If you have any questions, feel free to reach out to us. We're available and around always to answer questions. We'd welcome you on board with us. We think it's a great time to invest and deploy capital into the space. We're, as David alluded to, we're one of the largest single investors in our fund ourselves. So we're big believers and we put our money where our mouth is. We'll welcome you on board as well.
Excellent.
Thank you very much.
Thank you both, gentlemen. Everyone have a lovely evening and
have a great night.
Reach out.
Thank you.
Excellent. Thank you.